While the world focused on tariff headlines, currency tweets, and daily price limits, the real event happened quietly, inside exchange vaults and clearing systems. Screens showed silver, gold, and currency charts surging in synchronized chaos. Commentators called it a rally. Fund managers called it demand. Governments called it volatility. But none of those words described what was actually breaking. Because beneath the noise, the market was no longer trading metal. It was trading claims. Paper contracts multiplied faster than physical supply could move. Arbitrage mechanisms, designed for stability, began amplifying stress instead. Liquidity appeared. Abundant yet delivery capacity quietly vanished. Premiums detached from fundamentals. Margin rules strained credibility. This was not a bubble in price. It was a fracture in settlement. By the time limits were hit, subscriptions capped, and warnings issued, the outcome was already locked in, not as a prediction, but as a consequence of structure. History does not announce systemic failure with collapse. It announces it with rule changes. What visibly broke was price behavior. Silver, gold, and related instruments accelerated upward in tight formation. Daily limits were hit. Volatility expanded. Headlines described a rally driven by enthusiasm, inflation fear, and retail momentum. That was what the public saw. What actually happened was quieter and more consequential. Liquidity shifted, not into metal, but into paper representations of metal. Screens lit up, vaults stayed still, fund inflows surged while physical movement lagged. The market appeared liquid, active, and confident, yet the system underneath was already misaligned. The noise was constant. The signal was absent. This did not begin with speculation. It began with arbitrage incentives. A, tariff uncertainty and currency weakness pushed capital toward hard assets. B, investors chose liquid instruments, futures, ETFs, structured funds, because they were fast, cheap, and screen visible. C, each paper purchase created a claim without immediately removing physical metal from the system. D, the paper supply expanded faster than physical settlement capacity. This is the key mechanism. Arbitrage assumes that price differences between paper and physical will close automatically, but that closure requires liquidity, margin capacity, and willingness to take delivery. As volumes rose, margin requirements quietly followed. Capital that once supported arbitrage was redirected toward maintaining positions instead of enforcing convergence. The system behaved like a vacuum. Paper demand pulled prices higher, but instead of drawing metal upward to meet it, the vacuum pulled liquidity out of the arbitrage layer itself. Nothing snapped. The alignment simply weakened. The first step was invisible, higher margin usage. Then came volatility controls. Then daily price limits. Each measure reduced throughput. Each intervention slowed the system's ability to self-correct. Liquidity was not destroyed, it was constrained. This pattern has precedent. In 1980, silver rules changed after price acceleration. In 2008, liquidity vanished before defaults appeared. In 2022, nickel trading halted once prices exposed structural imbalance. In every case, rule changes followed stress, not excess. Noise increased. Functionality declined. Away from the screen, early indicators emerged. Dealer premiums widened modestly, then persistently. Delivery timelines extended without formal announcement. Inventory classifications shifted, with more metal labeled eligible rather than registered. Available in theory, committed in practice. Industrial demand did not disappear. It competed. These were not headlines. They were footnotes. And footnotes are where systemic stress first appears. The screen showed confidence. The dock showed caution. What visibly broke was nothing. Prices continued to rise. Volume increased. Confidence appeared intact. What actually broke was balance. Behind the screens, the ratio between paper claims and physical metal widened sharply. Futures, open interest expanded. Fund share creation accelerated. Synthetic exposure multiplied. None of this required immediate delivery, so nothing appeared constrained. The public saw smooth trading. The system experienced silent stretching. Metal did not leave vaults in proportion to claims created against it. Settlement was deferred. Delivery was optional. The market functioned, but only because demand remained abstract. This was the hidden event, expansion without extraction. The mechanism was mechanical and unavoidable. A, rising prices attracted capital-seeking inflation, protection, and currency insulation. B, that capital entered through paper vehicles designed for speed and liquidity. C, each paper unit represented potential future demand for physical metal, but imposed no immediate obligation. D, the paper layer inflated while the physical layer remained static. This imbalance persisted because arbitrage incentives were muted. To arbitrage paper into physical, a participant must post margin, accept delivery risk, finance storage, and withstand volatility. As prices rose, margin requirements increased. Capital that might have enforced convergence was instead consumed by position maintenance. The system became a bottleneck. Claims queued faster than metal could move, Not because metal was gone, but because the pathway from paper to physical narrowed. This is not failure, it is preparation. The first escalation was mathematical, not procedural. Higher prices meant higher margin. Higher margin meant fewer participants willing to bridge paper to physical. Next came concentration. Exposure pooled inside funds and clearing members. Risk became institutional rather than distributed. Then came quiet acknowledgments, disclosures about premiums, notes about volatility, language adjustments, and fund documentation. These steps mirror earlier episodes. In 2008, leverage concentrated before liquidity vanished. In 2022, LME exposure pooled before trading stopped. Each step increased stress by reducing optionality. Each reduced the system's ability to absorb shock. Physical signals began to diverge from screens. Dealer inventories appeared stable, but turnover slowed. Premiums over spot widened unevenly by region. Delivery estimates became less precise. Inventory reports showed a shift. Metal technically present, but increasingly encumbered. Eligible replaced registered. Availability became conditional. Industrial users began securing forward supply quietly, adding pressure without bidding prices visibly higher. What visibly broke was pricing logic. Spreads widened instead of compressing. Premiums detached. The relationship between futures, funds, and deliverable metal weakened. Yet trading continued. Screens still cleared. Contracts still printed. To the public, this looked like momentum. Internally, it was malfunction. Arbitrage, the mechanism meant to enforce discipline, stopped operating at scale. The bridge between paper and physical did not collapse. It emptied. What should have been a stabilizing force became absent. Arbitrage fails for only a few reasons. Here, all of them appeared at once. A. Rising volatility increased margin requirements on futures and fund positions. B. Higher margin consumed capital that arbitrage desks normally use to carry delivery risk. C. Financing costs rose as liquidity tightened across collateral markets. D. The cost of forcing convergence exceeded the expected profit. The incentive disappeared. Arbitrage is not ideological. It is conditional. The analogy is a queue. Paper claims lined up for conversion, but the entry fee, margin, financing, risk rose faster than the reward. Participants stepped out of line. Without arbitrage, paper prices floated freely. Physical prices lagged, constrained by logistics and availability. The system did not correct. It decoupled. The first escalation was withdrawal. Arbitrage desks reduced exposure. Next came imbalanced persistence. Spreads stayed wide longer than models allowed. Then came defensive responses, volatility controls, internal risk limits, and reduced market-making capacity. This pattern rhymes with history. In 2008, repo arbitrage vanished before credit froze. In 2022, nickel arbitrage failed before the LME halt. Each stage increased stress by removing stabilizers. What remained was direction without counterweight. Price moved, structure weakened. Physical markets registered the absence. Dealer quotes became conditional. Large orders required negotiation rather than execution. Delivery windows stretched. Inventory reports showed stagnation, metal present but not moving. Lease rates edged higher, reflecting reluctance to part with physical supply. Industrial buyers adjusted behavior, securing contracts earlier and holding inventory longer. This reduced float without visible price spikes. These were operational signals. They did not trend on screens. The screen still showed liquidity. A. Event description. What visibly broke was tone. Statements replaced silence. Warnings appeared where marketing once lived. Subscription caps were announced. Trading limits were reached repeatedly, then discussed openly. Language shifted from opportunity to risk. The public saw prudence. What actually happened was containment. Institutions began managing exposure optics, not returns. The concern was no longer price direction, but behavior under stress. The funds that had welcomed inflows now slowed them. Access narrowed. Liquidity promises were quietly qualified, nothing defaulted. But confidence fractured. The mechanism was institutional, not emotional. A. Persistent divergence between paper prices and physical constraints increased internal risk metrics. B. Rising margin and volatility forced funds and clearing members to reassess liquidity commitments. C. Continued inflows amplified potential losses if convergence occurred suddenly. D. Institutions intervened to cap exposure before the system did it for them. This was not panic selling, it was preemptive restriction. The analogy is a pressure valve. When pressure builds inside a closed system, release is controlled, or it becomes catastrophic. Institutions chose control. Arbitrage could not restore balance. Liquidity could not absorb exits. So rules were adjusted. This is how systems protect themselves. C. Escalation ladder. First came warnings, then subscription limits, then tighter trading rules. Each step reduced participation. Each increased concentration risk for those already inside. Historical rhymes are clear. In 1980, silver margin rules changed rapidly. In 2008, funds gated redemptions. In 2022, the LME rewrote its own trades. Rule changes do not calm markets. They signal that internal thresholds have been crossed. Stress does not recede, it migrates. Outside official statements, behavior shifted. Dealer premiums jumped unevenly, reflecting selective supply. Large buyers faced delays without formal explanation. Inventory data showed fewer transfers into deliverable categories. Legal language evolved. Prospectuses emphasized volatility risk. Disclosures referenced market conditions more frequently. Industrial users began bypassing intermediaries, seeking direct arrangements. This removed metal from circulation without affecting screen prices. Silence returned, but it was different. The screen showed stability. The system was bracing. By the end of institutional panic, the market still traded, but it no longer welcomed participation. What visibly broke was availability. Screens still showed contracts trading, funds pricing, and indices updating. But in the physical market, behavior changed decisively. Requests for delivery increased, vault movements accelerated. Metal that had been dormant began to leave the system. The public saw stable prices. What actually happened was extraction. This was not a rush, it was a transfer. Metal moved from pooled structures into private custody, industrial stockpiles, and long-term storage. Each withdrawal reduced flexibility. Each transfer tightened the system's tolerance for stress. Nothing collapsed. Capacity thinned. The mechanism followed directly from prior stages. A. Loss of confidence in paper convergence increased demand for physical certainty. B. Participants exercised delivery options embedded in paper contracts. C. Vault inventories declined, particularly in registered categories. D. Remaining metal became encumbered, pledged, or strategically withheld. Arbitrage could not respond. Margin costs remained high. Liquidity was insufficient. Physical replacement was slow. The analogy is a drain. Water leaves a reservoir faster than it can be replenished. The surface looks calm. Depth disappears. Paper claims still existed. But the buffer beneath them shrank. This is where system stress becomes irreversible. First came delivery preference. Then came inventory drawdowns. Then came internal thresholds. As registered inventories fell, exchanges relied more heavily on eligible metal that existed but was not committed. This blurred the line between availability and ownership. Historical rhymes are precise. In 2008, collateral left the system before defaults. In 2022, nickel inventories tightened before the halt. Each step increased stress by reducing optionality. With less metal circulating, any new demand had disproportionate impact. Liquidity did not vanish, it drained. Physical signals became unmistakable. Dealer premiums spiked sharply for immediate delivery. Fabricators reported longer lead times. Lease rates rose, indicating reluctance to lend metal. Inventory reports showed declining registered stocks and stable eligible stocks, a sign of hoarding rather than abundance. Industrial demand applied constant pressure. Manufacturing could not pause. Supply chains required certainty, not price exposure. This locked metal away for non-financial use. The screen still implied balance. The dock showed depletion. By the end of the physical drain, the system had crossed a threshold. Paper claims still circulated freely. Physical metal no longer did. What visibly broke was availability. Screens continued to show active trading. Contracts rolled, funds priced, volatility moderated. To the public, the market appeared to be stabilizing after excess. What actually happened was withdrawal. Delivery requests increased. Vault movements accelerated. Metal that had remained static for years began to leave the system. Not all at once, not dramatically, but persistently. This was not panic buying. It was confidence migration. Participants no longer trusted paper claims to resolve cleanly under stress, so they exercised the only certainty embedded in the system: physical removal. Nothing collapsed, but elasticity disappeared. The mechanism followed directly from earlier failures. A. Arbitrage breakdown left paper and physical prices misaligned. B. Institutional warnings signaled internal stress and rule fragility. C. Market participants reassessed counterparty and settlement risk. D. Demand shifted from exposure to possession. This triggered a liquidity vacuum. The analogy is a drain. Paper claims remain at the surface, but the reservoir beneath them empties. The system still functions, until it doesn't. Each physical withdrawal reduced optionality. Each removal tightened the margin for error. Crucially, replacement metal could not arrive at the same speed. Mining, refining, transport, and vaulting operate on fixed timelines. Paper creation does not. The imbalance became directional. The first escalation was delivery preference, then inventory drawdowns, then internal thresholds. As registered inventories declined, exchanges leaned more heavily on eligible metal present but not committed to delivery. This distinction matters. Eligible metal is ownership, not availability. Historical rhymes are precise. In 2008, collateral left the system before defaults appeared. In 2022, nickel inventories tightened before trading was halted. Each step increased system stress by removing buffers. Liquidity did not vanish, it migrated outward. Physical signals sharpened. Dealer premiums rose sharply for immediate delivery. Large orders required negotiation rather than execution. Delivery windows extended without formal explanation. Lease rates increased, reflecting reluctance to lend metal into an uncertain system. Inventory reports showed falling registered stocks and static eligible stocks, a pattern consistent with hoarding. Industrial demand applied continuous pressure. Manufacturing could not substitute paper claims for material input. Supply chains required metal, not settlement language. The screen still suggested equilibrium. The dock showed depletion. By the end of the physical drain, the system had crossed a critical point. Paper claims still circulated freely. Physical metal no longer did.